It's been a very busy week on financial markets. We've had the culmination of all major central banks from US, Europe and the UK coming together to talk about policy, and expectations running into this were high. Economic conditions are worsening. Most of the lead indicators that we are watching at the moment are weakening quite sharply at the moment, particularly here in the UK, where we saw very poor second quarter GDP numbers, and some of those forward indicators such as PMIs are coming in much lower than expectations. So the tension is turning to how are we going to sort it, and clearly that action turns back to the central banks. Much hope in terms of what they could deliver this week, and particularly in Europe, where Draghi was commenting in London just in the previous week that he will take any action required to defend the euro. So expectations are running high. In fairness, his conference did not deliver on any specific actions. It was more words, more promises, but there were some things in there to take away to the positive. He's going to address issues such as the seniority of bonds, if he were to use money to buy some of those periphery bonds. So there were some positives, but what I think it has left us is with another period, maybe 3-4 weeks before central bankers come back to the table again in September, with hopes where the markets are going to flip between optimism and pessimism, and so we'll take a look at some of the charts that may drive that particular flow. Currencies have been, I think, the major feature for this week. We're looking here at the euro. The euro has continued to remain volatile. We did see a range of 124 down to sub 122 just intraday on Draghi's press conference here at the moment. But again, you can see the underlying trend there of the euro. A weakening euro is in fact what the euro needs to become competitive again. And so, as I say, there are positives to be gained out of this weakening euro at the moment. We need to watch it ourselves here in the UK, because the UK has enjoyed a competitive currency for exporting into the euro, and if we suddenly find that our European trading nations are seeing a weakening off of their own currency, then of course it may become less competitive for the UK, which exports, I'm afraid, far too much to Euroland and less to outside of that particular sphere. So we need to just keep an eye on that for some expectations. If we turn back to other currencies, the pound against the euro, this is just the way that the euro has strengthening, so good for some holidays, good for trips out to Europe at the moment, but as I say, we need to think hard about some of our competitiveness in the export market. Against the US dollar, we have remained in a fairly sort of tight and bland range there at the moment. So just turning to some key features for the week, I'm going to start off with the Spanish yields. I think this is again is going to prove to be the chart that could unravel sentiment over the course of the next month. There was one piece in Draghi's comment where he suggested that any support that he would be giving to Spain and Italy through the periphery bond markets would be directed towards the short end, that is debt duration up to about 3 years. That leaves the 10-year debt market quite exposed to market forces without any real support expected to come in from the central banks. We saw the biggest move in yields following that comment seen for over 18 years. Where the yield moved up from 6.6% to 7.3%. The high is 7.7%, and as I say, if that were to re-breach those sort of higher levels, I can see sentiment being affected quite markedly against most risk asset classes. So that is going to be a chart to watch alongside the Italian market as well. If we go back to some of the poorer performing markets, the Spanish stock market fell by 5%, showing its vulnerability to sentiment swings in the eurozone, which is likely to continue. FTSE itself has performed quite admirably. It does have the defensive qualities. It has many international players that sit outside of the Euroland, and it has a high yield, so the FTSE has remained a much more solid performer. Indeed, you can see that it's been holding towards the top end of that range of 5,700. That level has been a breach level for the last month, and if it can hold above those levels, it does feel as a market that has got the scope to move higher. over the course of the near term. So one of the better performing markets at the moment. I want to turn a little bit to some other features which we need to keep an eye on in the soft commodity space. Two of the best performing asset classes recently have been wheat and corn. This is the chart of the wheat market, and we'll follow that up with a chart of the corn. You can see those sort of big moves that we've seen in those soft commodity spaces. That needs watching quite closely, as inflation in the Western world has been on the decline recently, supported by food prices that have been coming easier, and that's just been taking a bit of heat out of the consumer pocket on inflation. So if we do start to see a resumption, particularly in oil and soft commodities, then that is going to make life a little bit more difficult for central bankers going forward if they need to add some further stimulus to markets. Finally, want to talk about just a few sort of stock features for this week. You may have heard of Knight trading in the US. They've taken a $440 million loss when their algo systems, their computer-based trading systems, went spiralling out of control and ended up costing, as I say, the group $440 million. You can see there that it's taken about 75% off the share price, and that company is in now need of additional money. To the upside though, Vodafone has hit a high last seen since 2008, 2009 of 187. That's being driven by yield considerations there at the moment. High yielding shares continue to slightly outperform other equity asset classes at the moment. Next also hit an all-time high. The retail market is tough. We know that many companies have been underperforming in the retail space, but Next continues to show its pedigree this week with a small upgrade to its full-year numbers. It went into the sales period with slightly more stock than last year, about 8% more stock, so there may have been a little bit of hit to gross margin, but it shows a company that is a nimble operator in tough conditions, and the share price reward there is that it's now trading at an all-time high. And other companies that are at all-time highs, Rightmove has shown that despite a tough housing market, its own model of being a portal for estate agencies to advertise on their site is working incredibly well. Take a note that the operating margins of their profitability is about 75%. They're putting 75 pence out of every pound onto the profit line, so very operationally geared business in tough markets. To the downside, a couple of profit warnings are starting to permeate, and we can see here that they largely relate to construction or contractual work, long-term commitment projects, which are being cancelled with the confidence levels at the moment. Cape is a company that is suffering from that in Asia and Australia. And similarly in Atkins, it was more in their US division that they saw some cancellations. So we're starting to see some profit warnings. They seem to be at the moment concentrated, as I say, on long-term projects rather than shorter-term considerations.